Hello, everybody. I'm Bennett Tchaikovsky. Welcome to my video solution walkthrough. This is for accounting tools for business decision making. This is problem 25-3. Textbook authors are Paul Kimmel, Jerry Weingan, and Jill Mitchell. The question used in the presentation is copyright 2022 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. This video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are my own and not the authors of the textbook or of Wiley. All right, let's go ahead and get to it. So right over here, I'm going to kind of modify this question a little bit, and I'm going to make it just a pure, straight, present value question. And just because I don't want to get around with the internal rate of return and that kind of junk, I'd rather just basically say, like, let's make it into net present value. So over here, so we have Brooks Clinic is considering in its new heart monitoring equipment. It has two options. Option A would have an initial lower cost, but would require a significant expenditure for rebuilding after 4 years. Option B would require the rebuilding expenditure, but no rebuilding expenditure, but its maintenance cost would be higher since option B is a machine of higher quality, is expected to have a salvage value at the end of its useful life. The following estimates were made of the cash flows. The company's cost of capital is 8%. So when we get these questions, what we want to do is we're going to have we want to chart out the cash. So we have year 0, year 1, year 2, year 3, year 4, year 5, year 6, and then year 7. Okay, so for year 0, for option A, right? So year 0, I'm going to have a cash outlay of 160,000, right? So this is going to be my initial cash outlay. Over here in year 1, my inflows for option A are going to be 71,000. And this is going to basically be year over year. Okay, my outflows for year 1 are going to be 30,000. For year 2, it's also going to be 30,000. Year 3, it's also going to be 30. Year 4, 30,000. Year 5, 30,000. Year 6, and year 7. So my net cash inflows, I'm going to call this regular. I'm going to deal with that maintenance cost in a little bit, but I'm going to tell you why I'm doing it this way shortly. So if we look at this over here, so my net cash inflows are going to be 41,000 per year. I'm concerned with cash. I don't care about depreciation. If it says cash, that's great to me. If it says it's net income, that's different. Okay, so now with this, right, my initial investment, what's also going to happen here too is in year 4, I'm also going to have a rebuilding cost. And this is going to take place in year 4. Also, there's no salvage value coming at the end of the useful life of this. So now what I'm going to do is this. So I now need to go through the process of making these future cash flows comparable to this number here. So what I'm going to do is I'm going to say, okay, present value of an ordinary annuity of $1. And this is going to be 7 periods at 8%. So my payment amount is going to be 41,000, right, from right up here. When I go to the present value of an ordinary annuity of $1, I'm going to go to 7 periods at 8%, and this is going to give me 5.20637. I come over here. So the present value of the future cash inflows is going to be over here at approximately 213,000. but I also have some other things I have to deal with, right? So I've got to deal with this rebuilding cost, right? I don't want to use 50,000 because it's not going to have to be paid out for another 4 years. So for the 50,000 rebuild, I need to bring this back to today's dollars. So this is going to be present value of $1. This is going to be 4 periods at 8%, right? Why is it 4 periods? Because it's going to have to be paid 4 years from now. Okay. So here, 4 periods at 8%. This is going to be 0.73503. So the value of this in today's dollars is going to be 50,000 times 0.73503 or negative 36,000. What I'm now going to do is I'm now going to say I'm also going to subtract my initial investment. So my initial investment right up here is 160,000. So my net present value is going to be at 213 less 36 minus 160, or it is going to be 16,710. Okay. So again, the tricky thing about this is the cost of rebuilding, right? This 50,000 that's popping up. I did it intentionally like this because if I would have subtracted it from this, then I couldn't have used the ordinary annuity and I would have had, that would have been a pain, right? So this makes my life a lot easier to kind of go through and to do the question this way. All right. Now that we have this part of it done, let's go ahead now and take a look at option B. So we'll just go ahead and make our lives a little bit easier. And we'll just copy this up and just make some modifications. If only we had Excel during exams, always fun. Okay. All right, so option B. Okay, so the initial investment for option B is $227,000. Right, so this is going to be 227. There's no rebuilding cost with option B, right? There's no cost to rebuild. But we have as a little bonus is we're going to have salvage value. And my salvage value is going to be 8,000 at the end of year 7. So let's take a look at the numbers. My inflows here are 80,000. My outflows are 31,000 per year. So this is getting me so my cash flows over here are going to be 49,000 per year. So I can use the same factor, present value of an ordinary annuity of $1. This is being paid out 7 times, right? So 1, 2, 3, 4, 5, 6, 7. So it's 7 periods at 8%. That's the company's cost of capital. So right over here, what I'm going to go ahead and do, the value of this part over here, 49,000 times the present value factor gives me 255,112. Now for my salvage value, right, this is going to be worth 8,000. For this one, I'm going to use present value of $1 because it's a one-time payment. This is going to be 7 periods at 8%. Okay, so right over here, my 7 periods at 8%, I'm going to go to the present value of $1. This is going to be 0.58349. So when I multiply 8,000 by 0.58349, it's worth about that. Over here, my net present value is going to be at 32,780. So when I look at the different options, the present value of option B is double that of option A. So again, option B looks like the better option from this point of view. Now, for the internal rate of return in terms of like what makes this what makes the net present value go to 0. I'm sure there's a way we could do that on Excel, but I'm not going to do that with you guys tonight. I'm just going to pause real quick. Hold on. Okay, our numbers are good to go. The profitability and the profitability index, what they're doing is they're taking, it looks like they're going through and they're taking the amount of, they're taking the net cash flow and they're dividing it by the initial investment of 160. And so they're coming up with a profitability index of 1.1, which means that's probably how much it exceeds its initial investment by. For the profitability index here, this would be 259 divided by 227. And this is going to be slightly higher. Again, it's not something I've really used, but that doesn't mean that it's not a valid metric. It's just, I don't really use it. I haven't really used it. And then the internal rate of return is what's going to make the net present value go to 0. So have fun with that one. But in any event, I want to thank you for being with me here tonight. Also want to thank Wiley for allowing me to share my solutions with you. Makes it a lot better for me when I'm going through and preparing material for my classes. And so I look forward to seeing you on the next video. Have a great rest of your day.